Investing is not a get-rich-quick scheme. It's highly unlikely you've ever met someone who's achieved their financial goals in that way. Most wealthy people did not get rich overnight. It takes time. I'm Scott Connor, a 30-year veteran trader, and you'll learn about the power of compounding right here on Virtual Trade. Welcome to Virtual Trade. In this episode, we're going to analyze the effect that compounding can have on your portfolio. We'll discuss what the key components of compound interest are and examine a program available on the TD Ameritrade website that can assist you in your efforts to grow your account. And finally, new trader Jenny Horne and I will look at a tool that might help illustrate a clearer picture of the potential of her investments. So take your seats and grab your notebooks because it's time to tackle compound interest. With a little bit of interest and an extended period of time, compound interest can help grow a portfolio significantly. Compound interest is reinvesting earned interest back into the principal of an investment. As you reinvest interest on top of interest, your investments can grow exponentially over time. Now, exponential growth is the result of letting interest compound over time. For a moment, consider homeowners who need to water through the summer months to keep their gardens healthy. They may have a hose, but they can forget to water on the hottest days of the summer, and it results in wilted flowers. Now, it's difficult for the flowers to recover, and in markets, it's difficult to recover from a severe market decline. Now, an automatic sprinkler is similar to the dividend reinvestment program. It allows the gardener, or in this case, the investor, to go on autopilot. Now, it's time to dive further into the topic of compound interest.
Let's discuss 3 ways how you can harness the power of compounding. The first step, and perhaps one of the most important, is to start investing early. The earlier you start, the sooner you can start taking advantage of time. The next step is reinvesting earnings. When it comes to investing, earnings are typically in the form of capital gains and dividends. Some brokers may allow you to automatically reinvest these earnings, or you may choose to simply buy different investments. The final step is to avoid one of the biggest obstacles many investors face, taking excessive risks that can lead to large losses. After all, compounding only works if you're earning on your investments. Of course, always earning a profit is easier said than done because investments sometimes make money and other times lose money. You can't guarantee your investments will make money, but you can avoid taking excessive risks that may lead to large losses. Measures such as allocating your portfolio across different asset classes and diversifying your portfolio within each asset class can help reduce some of the risk in a portfolio. However, asset allocation and diversification do not eliminate the risk of loss. To potentially help avoid large losses, resist the temptations of taking excessive risks or not taking any risk and staying on the sidelines. Because when it comes to compound interest, slow and steady can be a highly effective approach.
So to recap, compound interest is reinvesting earned interest back into the principal of the investment. These reinvestments earn their own interest and compound over time. And compounding over a long period of time can potentially lead to significant growth in your investments. Time now to explore some important elements of compounding.
Let's look at a hypothetical scenario to better understand the potential power of compound interest. Suppose there are 2 investors who have a starting balance of $10,000 each. They both decide to buy the exact same investment on the same date, and they both plan to hold their investments for 30 years. But one investor plans to withdraw the interest at the end of each year, while the other plans to reinvest the interest and let it compound. Let's fast forward 30 years to see the difference in potential returns. In this example, let's suppose that the investment earned 7% per year. The investor withdrawing interest every year would have earned $700 per year. Over 30 years, the earnings would have totaled $21,000. But let's see how much a difference reinvesting the interest could have made. The investor who reinvested the interest would have possibly earned $76,123. This is more than triple the returns of the other investor. This example illustrates the power of compound interest. Now, let's take it to another level and discuss the importance of time. Compounding over a long period of time can potentially lead to significant growth of an investment. Let's look at another hypothetical example to understand how important time is to compounding. Suppose two investors have portfolios worth $100,000 each. The portfolios hold identical investments. Each year, both investors save and invest an additional $10,000. And let's assume that with compounding, their portfolios grow 7% per year. One investor needs the money to retire in 15 years. The other will need the money to retire in 30 years. Let's see what a difference 15 years can make. At the end of 15 years, the investor's portfolio would have grown to $527,193. Now let's see how much the other investor would have earned. As you can see, the additional 15 years of compounding resulted in his portfolio growing to $1,705,833. That's over 3 times the return of the other investor.
As we wrap up, it's important to remember, compound interest is reinvesting earned interest back into the principal of the investment. Now, compound interest only becomes powerful when given enough time to work. And the 3 keys to stock portfolio compounding are starting early, reinvesting your dividends, and avoiding excessive risk. Welcome back. It's time for Tools of the Trade, where we look at various tools within TD Ameritrade, Thinkorswim, and Mobile Trader. In this segment, we're going to be examining Dividend Reinvestment Program on the tdameritrade.com website. We'll be looking at dividends, we'll talk about positive compounding, and also we'll investigate the active DRIP, which stands for the Dividend Reinvestment Program. So what we'll do is we'll start off on the tdameritrade.com website. As you can see, we have it up right now, and remember, we just logged in using the same username and password that we used to log into the Thinkorswim trading software. And you can see that what I've done, I've gone to my account, and right now we're presently looking at watch lists. Where we would like to go to learn a little bit more about dividend information and the dividend reinvestment program is stay on my account and drop down to the dividend reinvestment tab. So we'll go ahead and click on that, and this gives you a nice overview of how the dividend reinvestment program works at TD Ameritrade. You've got some information here about enrolling. You can get some more information with a terms and conditions PDF that's available here as well. But let's just read real quick. The Stock and ETF Dividend Investment Program, or DRIP, allows you to reinvest your cash dividends by purchasing additional or fractional shares in your account. So what that means is when you receive your dividend, typically in a cash form, that money is used to go ahead then to repurchase shares or fractional shares of that same stock. Now, what do we mean by fractional shares? Well, sometimes the amount of the dividend, and we'll use an example here coming up, you'll see that the amount of the dividend is not quite enough to purchase one complete share or one whole share. So in that case, we'd have to use that dividend to buy a fraction of that share, which is typically available or available on many of the stocks. There's over 5,000 stocks available on the DRIP, or the Dividend Reinvestment Program. So let's walk through a couple examples here so we can get familiar with exactly how this works. Clicking up here in the symbol box, let's put in, let's just choose Microsoft. MSFT would be the symbol. Let's go ahead and hit enter on that. And you can see that takes us to the profile page of Microsoft. Now, where do we find information about dividends with Microsoft? Well, very simple. If we come down here, we're looking at a 1-year chart of Microsoft. Now, just to the left of that chart is where you can see annual dividend and yield. Now, the annual dividend in this case is $1.68. $1.68. Now, that tells us if we had 100 shares, we would get an annual dividend of $168. Now, what about the quarterly rate? Because typically, not always, but typically dividends are paid on a quarterly basis. Well, of course, let's just take that $1.68, divide by 4, and that will give us a quarterly dividend of what, 42 cents, if I'm doing my math right. Now, what is the yield on this? Well, just take a look right to the right. It says 1.55%. Okay, so that $1.68 divided by $108 a share, which is approximately where it is for this episode, gives us about a 1.55% yield. Don't forget, the annual yield right now in the marketplace for the S&P 500 stocks is about 1.75, so you can see this is just slightly below that. All right, that's some information there. What if we want to get more? Well, let's go to the calendar. And on the calendar tab, we have some important information. You can see under upcoming events, you can see information about dividends. Now, the last dividend you can see was ex-dividend date was August 15th. Now, ex-dividend date, obviously a very important date. That is the date that the stock is paying X the dividend. In other words, it's already been paid out. You would need to own the stock the day before the X dividend to collect that dividend on the X dividend date. If you had options, they would have to, for example, be exercised the day before the X dividend date. So X dividend date, a very important date, as you can see. Take a look at the dividend. It's 42 cents. You can see that there, and some other information there. Now, what if we want to get a little bit more information on this? Well, we're going to go ahead and take a look at the Fundamentals tab. And now you get the company profile. Well, within this company profile, obviously you can see that there's some nice charts here that tell us a little bit about the stock movement, or how the price has moved up and down for the last 5 years. But I'm going to drop down here a little bit lower, which says historic growth and share detail. And you can see right here on the dividend histogram, you can see that it says 13.14%. Now, what is that telling us? Well, that's telling us over the last 5 years that the dividend on Microsoft has increased about 13% annually. About 13% annually. And what we saw earlier is that the dividend is now 42 cents and that it has changed over time. If you go back to calendar, I believe it's calendar, we can scroll down and see past dividends. And you can see it's 42, but of August of 2017, it was 39 cents. So there's an example of how this 13% number is determined. So again, it's paid a dividend, but you can see it is annually moved up about 13% on that particular payout. Now, let's put another stock in there just so we can get a quick idea of how else this might work. I'm going to put in Amazon, AMZN, enter. Now, take a quick look at Amazon. When we look down at annual dividend, look at the first thing it says, no dividend, right? So Amazon, more of a growth type stock, but does not pay a dividend at this present time. So what would that mean for the dividend reinvestment program or the DRIP program? That would mean it's not available for the DRIP program. So that's very important. There are certain stocks that will and certain stocks that will not be available for the DRIP. All right, well, that pretty much wraps up our segment on dividends, the dividend reinvestment program, and where to find more details on the stock, its dividend history, and what its payout is at this present time. Now, don't forget, for more information on these tools and other great education, visit the TD Ameritrade Education Center on tdameritrade.com. Welcome to Virtual Trade. I'm joined by new trader Jenny Horne. Jenny, good to see you again.
Thanks, Scott.
We're going to talk about something I think that's very near and dear to traders and investors, and unfortunately it's something they don't always think about, and that is retirement. Jenny, do you think about retirement from time to time?
Not really, not yet much at all.
Yes, well, you're very young, but it's still, that's most likely the best time, as you'll see, to start thinking about retirement.
Yeah, I mean, I have to say, I just think about more the next years to come. I'm not very good at planning so far in my future.
Okay, well, what we're going to do is we're going to jump into the tdameritrade.com website, and we're going to take advantage of a tool they have there called the Retirement Calculator. So what this is able to do, it's going to be able to give you a view of it. Okay, if I start to plan for my retirement and assess what my goals are, how would I save and make sure that I set things up so that I could achieve those goals so that if I do get to my retirement age, I'll be okay.
Yeah, I mean, I would love that.
And again, we're looking at a model, and as with all models, there's no guarantees that all these things work out because, of course, we never know where the market's going to go and what the annual rate of return is and things like that. But you'll see as we go through the calculator, there's a lot to this.
Great, I'm excited.
All right, well, let's dive right in. We're going to go into the tdameritrade.com website. As you can see, we've logged in. We're on the My Account tab. And what we're going to do is go to, obviously, Planning and Retirement. And then, Jenny, what we'll do is go to Retirement and then click on Overview. Now, I've already done that, so I'm going to bring up the Overview page for us so we can bring that up right now. And there it is. This is exactly what it'll look like. This is the retirement calculator. So let's go through the steps together, and I'll let you go ahead and start typing in. And right now we'll start, as you can see, step one is some personal information.
Okay.
So you can put in your name.
My name, which is easy.
Right.
I am a female.
Okay, perfect. Now it's going to ask birth date because obviously it's going to be make some assumptions about when you will be retiring. It will calculate when you can start drawing Social Security and things like that.
Right.
So it's important that you use an accurate date on that one. Okay, marital status, that is totally up to you. Employment status, employed. Now, employment income. So again, this is something you obviously want to be as close as you can for accuracy.
Right.
But again, we know those numbers will change. So let's just start off, Jenny, with a round number here. Maybe we'll put in 50,000. How's that?
Great.
All right. So someone who's a young professional starting off their career, we'll just use a round number. Other income. So we'll just go with nothing for right now? Okay, that's fine. Where do you live? You might think, why do they ask this? Well, it depends where you live. Taxes, a lot of things factor into how you retire and what kind of benefits you potentially could have.
Right, so I currently live in Illinois.
Okay.
I do not plan to retire in Illinois. At least I hope not.
All right, so pick a state.
Okay, well, I would like to retire, I think, in North Carolina, so I'll put that.
All right, no, absolutely. We'll go with North Carolina.
Great.
Now you hit the next button in the upper right-hand corner. Now we've got the personal information in there. And now just a couple more things. So they want to kind of figure out where your expected life expectancy is. I know that sounds kind of morbid to think about, this, but again, this is very important. And that's why many people don't think about this, I think, Jenny. They say, oh, well, that's something I'll worry about later. Well, no, there's no better time than right now to start this planning process. All right, so let's go down to the questions they're asking you for you. First of all, are you a smoker?
No.
You put no.
I can say my health. I think my health is excellent.
Okay, great.
I'm optimistic here. And my family lives a very long time. I have grandparents who are 100, so I'll say longer than average.
All right, good genes, Jenny. Again, you want to be honest about this.
Yeah.
And again, it's asking you for accurate. The more accurate you are with the information going in, the more accurate the potential model will be when it comes out.
Maybe knock on wood, but I think that I'm pretty healthy.
All right, well, take a quick look. I'm going to put my glass on. Now, it says Jenny retiring at 65.
Okay.
And then Jenny, with the information put in, Jenny should be living till 93 years old, 2088.
That sounds like forever away.
It does seem like a long way away, but again, this is what it needs to make the planning decisions as we go forward. So, all right, so we've got all that information in there. It says, based on your selections, your money will need to last you for approximately 29 years of retirement.
It's longer than I've even been alive right now.
Okay, but again, this is good. It's putting together sort of a model for you, or some retirement type of goals you're going to want to have.
And that's pretty cool, because I really would have no idea how long I would need to save for. Now it tells me an estimate right there.
Exactly, especially, and again, things can vary, as you'll see. We'll be able to change some of these variables as we go forward. All right, so I think we got everything there. We'll go to next. Maybe a couple other things that it's asking you for. Let's see, what do we have here? Living expense goal. All right, now this is going to be that once you do retire, how much would you like to pull out in annual income here? What would be available for you for annual income?
Right.
All right, and we can see that number right now works out to be, what does it say right there?
37,000.
Yeah, we can round that close to 38,000.
Right.
Okay, perfect. So now we have a number. Let's keep that number in mind. It's close to about 38,000 at this point. So without what we put in there. Okay, we'll keep that in mind, and then we'll go ahead and hit next. And remember, as you're going through this process, Jenny, there are a lot of different places on the retirement calculator that will give you further explanation of the different numbers that you're seeing.
Okay.
And again, those are typically in blue. So you'll just, if you hover over your mouse, click on that, little box will pop up and it'll give you more information.
That's great.
All right, so now let's talk about Social Security benefits. Are you eligible to receive benefits?
I think so, yes.
By default, yes.
Yes.
If you're paying taxes, generally that is true. Are you currently receiving those benefits?
No, I am not.
No. All right, good. So that's very clear. When do you want to begin receiving those benefits? Now you can see right now it's going to assume that 65 is when you could retire, and you could start. And right now it's going to assume that you're going to collect benefits. I think right now it says 67. All right. So 67 would be the ideal time for you to start taking benefits, I think, according to this.
Right. I like that it says use the slider to see how long waiting can increase your benefit, because I think that it's saying if I retired here, it goes to 20,000. Then if I wait till 67, it goes to 22,000.
Now this is a great point. When you do get to that retirement age of 65, it's trying to find sort of a more maximum or peak area where it would be actually more beneficial. So if you waited till you're 67, you can see right there exactly what that number is. And the longer you wait, obviously the higher the Social Security benefits would be.
Yeah.
All right, let's scroll down. Anything else that we missed there, Jenny? I want to make sure before we go to the next. All right, so you've got benefits, and of course it tells you your lifetime benefits there as well. To the right, it says about 600,000. Okay, now if you had other sources of retirement income, you could certainly add those to the bottom of this page. So you can see that blue when you scroll down, there is a space there that provided additional benefits. If you do click on that, Jenny, let's just go down there and take a quick look. If you were to add other benefits other than that, you'll be able to do that here. All right, so let's keep going and to the next page. And let's see, are we there now?
Oh, I think it didn't like that we opened this. We can just delete
that. Let's go ahead and delete. Good point. All right, that's a good catch. All right, well, let's go to next. And now it was like the assets and employer-sponsored plans. So if you're working, most people, many people, not most, but many people have a 401k provided through their employer.
Right.
So it wants to know, in addition to Social Security, what other, what should be calculated into your retirement model. So again, let's have some questions here. Let's go ahead and take a quick look. Other assets, and let's go down to how is your retirement assessments currently invested. So it's going to ask you about your 401k. Well, first of all, let's go up to where it says 401k. Let's add that. And you do have a 401k.
Yes, I do.
Now, if you're young as you are, you probably don't have a lot of value in that portfolio yet, that 401k.
Correct.
So let's go ahead and let's put something in anyway, maybe 2,000 or 3,000.
Okay.
Just to say that we've had maybe a couple of years to get that started. Annual contribution. Let's see, what do you have on that one? It was, let's hit edit there, and let's say that you're going to be contributing. Typically, people, maybe, it depends if you have matching, maybe somewhere between 6 and 10%. We could just put 6 in for right now.
Okay.
As a contribution. Okay. All right, good, we got through that. Other assets and how are your retirement assets currently invested? Okay, so let's take, this is an important question too. So how much is in cash? I'm going to guess a small portion. Maybe let's just put in 10% for that.
Okay.
In bonds, maybe 30%. Since you are young, you probably have a more in equities and stocks. So let's put 60% in stocks. All right, so that seems like a fairly, let me grab the mouse, I'm gonna just drag down. All right, I think we're set here, and let's go forward. Now again, these numbers could vary from individual to individual, but I think we're just kind of putting together just a general idea of what it would be at this point.
Right.
Okay, now risk 1. Select your target portfolio and review its potential loss. Is it beyond your breaking point? So now we need to slide this to the right.
I remember I'm more risky because I have more years until my retirement.
You are looking at what we call a growth portfolio, and since you're young, you're going to have plenty of opportunity to navigate the ups and downs of the market before you get to retirement.
Right.
So you've got plenty of time.
You put it in a good way. I have lots of time.
Right, and oftentimes financial planners will look at that and say that it's not such a bad thing to have more exposure to the stock market since you have so much time between now and I almost said expiration, retirement. Okay.
Now an expiration.
All right. So far, so good. Now, it's assuming an average return of 7%, and that's important because that could be a variable later on. All right, so let's keep going. Now, here we go. Drum roll. Jenny, take a look. What does it say? Will you have enough retirement to last for your 29 years of retirement?
No.
And it says no. You'll run out of money in 14 years.
Oh, no.
Oops.
So
okay.
I might have to work a little bit longer.
Right. So now we're at the point where would I like to be on this calculator? Well, if you come to the right side here, I'm going to move my mouse. There's 3 different zones, and you're in the zone of the purple zone, which gives you about a 33% probability of meeting your retirement goals. That's not a great probability.
But I'm almost at the green part of it.
Right. Well, take a look here. The green is where your money runs out. Now, obviously, it's planning that you'll live out to here, 2088. Well, there's no income left here. So there's the concern. Now, the question is, now that you're here, how do we get into the green or the blue zone, which is a much higher confidence of this? And again, if you'd like to get more explanation on these answers, just click here, and it'll give you a lot of information about how things are calculated. So again, these are great things to click on as you're going through here. Now, Jenny, the next thing is, how do we get to meet these goals? How do we get this cash to last all the way till your expected age? Well, now we're in the final zone where we can actually start making some changes in this. And now you can see that it did some changes for you here, and you can see, hey, now if we make some small changes, you're moved into 51%, which is a little bit higher. And what you can start doing here is look at the changes they made and continue to make other changes yourself. So in other words, if you want to solve for retirement years, you can change those. If you'd like to say, well, maybe I'll change my annual retirement living expenses, I can change those as well. All right, so when these things happen, on that last page there, Jenny, you're able to go ahead and say, well, listen, how can I meet that goal? Well, one is you can change the amount that you save.
Right.
All right, that makes sense.
That's fair.
So well, the first time I clicked on age, I said, I don't want to do this because the only solution to that is you live a shorter lifespan.
Yeah, I don't want to cut my lifespan.
So I jumped past that one for sure. So again, these are important things. What if I got a higher rate of return? Now that would help. That would also help to meet those retirement goals as well.
Yeah.
Right. So on that last page, it's very important to go ahead and change some of the factors just by sliding on the bars and seeing what would happen if I actually added maybe an extra $100 or $200 a month. How would that help me meet those goals? And you'd be amazed at just changing an extra $100 a month, what that does to retirement goals.
All right, yeah, I mean, as you can see, it's important to go back and change all of those things, or else I won't retire very well.
And that's one of the fun parts of this tool. All right, well, Jenny, what did you think about this and retirement and using a tool like this?
I thought this was great. As I said, I had no idea really how I'm going to retire, and this gives me perspective of things I need to change in my lifestyle or things I need to do moving forward.
This is a great feature on the tdameritrade.com website. I totally agree. All right, well, thanks, Jenny. That was a lot of fun. I think very educational for not just yourself, but everybody watching.
Thanks, Scott.
And I certainly look forward to our next session.
Me too.
In this episode, we analyzed the effect that compound interest can have on a portfolio and how it's determined. We examined the TD Ameritrade Dividend Reinvestment Program. And finally, we looked at how the retirement calculator on the TD Ameritrade website can potentially benefit Jenny. I'm Scott Connor, and thanks for watching Virtual Trade.